Reasons why retail traders lose, part 3, variables. So far we've looked at patience, we've looked at trading against trends. So here I'm looking at the aspects of variables. Now, variables are really split into two levels. There's those that you can control and the variables you can't control. So let's look through firstly those you can't control. So that includes things like price action. You cannot control it yourself. You may have a trigger or whatever it may be that you can control, but you cannot control what the price actually does. Next, you've got ad hoc news that just comes out, and maybe a speaker, it may be something that was unexpected. You can't control it, so it's just there. It happens, and this is the part of the risk of trading. Trading has its risk, and then there's news reaction. Now, generally, you might be able to control not trading when the news is coming out, but if you're in a position already, you may be quite profitable, and then suddenly the news actually takes it the opposite way altogether. So these are things, as I say, you can't control the reaction of, and it may be something that the news comes out in such a different degree, it's such a surprise that it really moves the markets. You can't control the volatility of the market in terms of the how much it's going to go up and down at any stage. So these are definite things you cannot control. So on that basis, you've got to work on those things then that you can control. There's plenty of things we can control. For example, position size, and I'm going to use position size as a prime example. And I could have probably just done the whole video on position size because it's such an important aspect. Now, firstly, I'm just going to run through, if I can, a quick example of how a trader might be trading. So this, I've got some variables which are controlled. So one of my strategies, it has a set target, so that is controlled. I could change the target, but I have the ability to set the specific target, so it's controlled. So that's one thing. It's got a full set of rules. I can control all of those, so that's fine. But then it comes to the position sizing. I can, as I say, I can control those as well, of course, but a lot of people don't, and they'll get a strategy and they could take my strategy, and it gives a 1.3 return on a winner. So let's assume we've got the first one as a winner. It then gives another 1.3 on this particular. I'm just taking how it's run for the last few months. So that it's looking quite good. Then you get a loser. That's fine. You get a break even, and then all of a sudden you get a nice winner. You think, this is good, and then another winner, and you're sort of thinking, crikey, this is really good. And then you get another winner. That's lovely. And then all of a sudden you look back at your results and you think, well, this is going well. I'm going to double up. Instead of 1% per trade, I'm going to change this and vary it to 2%. So it's going so well. Well, next trade comes in, and you get rewarded for doubling up. You get a nice 2.6. Next trade comes in. Unfortunately, it's a loser. Instead of losing 1%, it's suddenly lost 2%. You're not too sure at this point here, and you think, well, I'll do just one more trade at this level, and it comes in at a -2. So then you sort of go in with just 1%, and as it happens, it breaks even anyway. There's no win, it's not a loss, it's moved to break even. And then you get another loss in there, -1. And now you're thinking, well, hang on a minute, it's gone off the ball a little bit here. I've lost 5% over the last 4 trades. I'm going to halve this. I'm going to reduce the size of my trades, and so you halve it. And so the next one, it's a winner, but because you halved it, you get 0.65 all of a sudden, and you think, okay. And then the next trade comes in, it's a loser, so you lost 0.5. I was right to do that. and then the next trade comes in, it's a winner, and you get 0.65. So you've again only got half. Then you're thinking, well, okay, I'll go for the full size, and you get the full size. You get the 1.3, and it wins, and you get a 1.3. This is how it's been going. And then again, you'll take another trade, and this one won as well, so you got a 1.3, and then you get a 0, so break even, and then a loss, so -1. So you're going as is at the moment, and then you get another 0. Maybe you don't even take the next trade, but I'm not going into those. That's even another variable in terms of not taking all the trades. I didn't include that as a variable that you can do. Let's assume you've taken all of the trades though, and then the next trade comes in at 1.3, so you're sort of coasting along now a little bit, and you're feeling a little bit more comfortable. And you look back and you say, well, actually, over the last few trades, I probably messed up. I should have taken. Actually, it's a -0.5 there. I would have actually done all right out of this. I should probably double up again, because it was doing me well for a little while. Let me just put my minus. There we go. So you double up. So you just had a loser, two break evens and a loser, but you've had some winners beforehand, and you double up and you end up with a -2. Now you're just thinking, well, there's something wrong here. I'll just go. I'll go half the size again, and it benefits you because it's a -0.5, and you're so concerned at this stage. You're even, as I say, deciding whether or not you're going to take the trade. But of course, you take the next trade, and it's 0.65. So you're thinking, okay, it's fine. I'm okay with this 0.65. Next trade. Perhaps I should be getting back to where I should be going back to. Kim said 1% is what it is doing. I'll go for a 1.3. Go for a full 1%. You get a 1.3 coming through there. So you can see how this is going. Next one, 1.3. So you've then had 4 winners in a row there, and you're thinking, well, I'm going to double up again. You get a 0. It's almost just as you're thinking about doubling up, it's sort of 0. So then the next one, it's a loss, so it's -2. and then you go back to normal, and you're sort of okay. 1.3, 1.3, -1. So you've gone all over the place there. And what have you earned from doing this? It's going to be interesting as I do better on this example than what actually came from it. 7.8%. What could you have earned just by keeping it consistent? Drag this in if I can. There you go. That was the actual results. I don't know if you can't see the bottom of that. It's 13.7. There you go. You see it. It's going to mess me around. It was 13.7 was the actual if you'd gone in and kept it consistent. So there's the big learn. It's either 7.8, 13.7. It's 0.6 difference. The other thing is, because you're starting to mess around with it affects your psychology behind trading it. What else can you control? You can control the markets you're trading. I know too many people that want to that trade everything. They want to be in the bond market. They want to be in. Well, no, they won't touch Forex, or maybe they will, maybe they won't. They'll be in some stocks and some equities and commodities. Oh my goodness, they love commodities, and they go through all these different markets. So they effectively become a bit of a jack of all trades and a master of none. So the thing about the markets is actually mastering the markets in terms of what you're doing. The more variables you've got there, and this is one of them, too many markets can have a big knock-on effect on your trading results. if you're looking at Forex, for example, pairs, they start off looking at maybe just a few pairs, and all of a sudden they get a bit bored with just a few pairs, so they introduce, apart from the majors, they then do the major crosses, and then they think, oh, these exotics have got much more movement, I'll trade these, or I'll trade some crypto. So they mess around with what they're trading there, and they're not consistent. They have a few winners, and they leave. They double up, or they stick with something, and then they'll go through a process of some losses, and then all of a sudden they'll fall out of love with it, and it's not working. So the next thing is timing. You can decide on when you want to trade. So it's a variable you can control. The risk of the market is effectively, I've talked about those trades and given you that example. That's assuming that you get every single one of them. That on that particular strategy, I turn it off when there's major news, so it's not going to be traded. It's a relatively short-term trade, and it gets switched off. So timing is important, but I only trade it between certain hours of the day, and on one of the pairings, because of my analysis, there's a certain period between 10 and 12 o'clock. It just doesn't like it. It's just not good at all. So I don't trade it between that time at all. From my long-term analysis, the timing's there, so I can control the timing. I don't want to trade pre 8 o'clock, because it's where a lot of people seem to lose a lot of money, and it has more variability about it, and I don't trade much after 3 o'clock on some of my strategies, because it's the peak performance from them. So I'm looking at the peak performance, but I can control that. Your strategy, depending on what you're doing, may have different parameters, and it works through different times. But it's all about, and the purpose of this video was controlling the variables you can control. So what you can do is you can work out your position size for each trade and keep it consistent. Now there are tools, if you're not familiar with currency tools, if you're sort of a little bit not familiar with them, things like this is a calculator. You can pop the specific pair in that you're trading. Let's just go for, well, let's just leave what's there. It's a pound CAD, that'll do. The account currency you're in, let's say you're in the UK, you might put sterling, or if you're in Australia, your Aussie, of course, if that's your currency. You can put your account size, let's say you've got 25k in there, and then you're willing to risk. Now this is the consistent one, of course, where you can be consistent, and that's your risk ratio, so it 1%. Your stop loss, well, that is probably a variable subject to the setup. Some people may have a fixed stop loss, so it's a bit of a question. Some will, some won't. It's something you can certainly control, but you certainly should have one. So let's just say in this case it was 50 pips, and then trade size in lots. Again, well, that works itself out, and then you get the actual risk of the trade, the sizing, 0.44 lots on a full size contract. It gives you everything there, so you can be consistent all the time. You can work out and ensure that you meet the position sizes. You can thin down the markets and look at the markets that are more profitable for you, and just trade those. Why trade everything when you can trade the ones that are making you money, or the ones that are more interest or just work for you? Whatever it may be, sticking to the markets that are winners, and the ones more importantly you understand. It may be that you really only understand stocks, and even in the stock world there might be a few sectors that you understand really well. You may work in the oil industry and understand all of those. Why not work where you know? Pairs, again, it's when you start breaking down. I'm referring to pairs here. It could be sectors, it could be anything that you can control. Stick to it. Timing, work out the best time of your trading. If it's longer swing trading, day end of day position trading, then the timing might not be such a big thing, but you might not want to be trading over Christmas or big major holidays. So they're the things you can control, and you can do it all yourself. In terms of these aspects, there's nothing you can do about them, and you've just got to accept that. So there we go. Giving you some of the reasons. One of the biggest reasons is that, well, the position sizing itself. I know there's too many variables. Of course, then when you get a strategy, I should have put you can control taking the setups. As soon as you start saying I won't take this one, I'll take this one, and the risk is there. As much as you may not like the look of something, and I sit there very often on my strategy and think, don't like the look of this one, and you can guarantee as soon as I say that it will win. Others which I think are absolutely set up beautifully don't win. So it's a case of, it's a variable I can control, I can trade it. So I'll only ever turn it off for the reasons of timing, of news, etc. Hope you find this useful. Sorry it's quite a bit of a long video, but it's a very important video because we can learn from what these other retail traders are doing. Hope you find it useful. Bye for now.